Everyone my age, and I'm getting up there, remembers hearing about the digital future. Well, the truth is, we've been living in the digital future for pretty much our entire lives, whether we realize it or not. But now it's become more omnipresent. It's become more of a tangible part of our lives. And it's not an accident that the digital future has seemingly touched the monetary system, maybe last, because money is a funny thing. It's all about faith and trust, and it's all about feeling comfortable with it. And so, a radical shift, or what may appear to be a radical shift in monetary mechanics, how it all fits together, how it all works, that's something that you have to take very seriously. And of course, a big part of that has been cryptocurrencies and the rise of digital currencies over the last 15 years, really since Bitcoin launched. And so here at Eurodollar University is part of our ongoing efforts to really illuminate these monetary topics. We don't always want to look behind. We don't always want to look at what the Eurodollar system was and what it already did. We really want to look ahead, especially as we have all of these disruptive technologies and all of these opportunities that are really coming up. But in order to really take advantage of those and really understand them, we need to talk to people who are doing this, people who are inside the space, who are living and breathing that digital future. And I have someone just for that. His name is Manny Rincon Cruz. And Manny, you've been in cryptocurrency digital projects for basically your whole career so far, right?
Yeah.
I mean, you're involved in a whole bunch of stuff. So why don't you give us a little bit of background about your experience in the space?
Yeah, of course. So I'm currently the founder of, I guess, the two things that take up most of my time. One is a group of protocols under the name Buttonwood. So we run a liquidity clearinghouse protocol that just basically serves as a liquidation pool for yield-bearing assets. And then the other thing that I do, it's funny that you mentioned about not looking to the past. I'm trained as a financial historian. I started out as a mathematician, or I guess in philosophy, doing set theory. I then went over to history.
What is it about the philosophy people that want to wander into finance and money?
Well, to be fair, I wanted to be an economist. And then I think after attending some economics classes, I realized it was a very sterile, kind of narrow-minded field in terms of the questions that were going to drive most of the research. And I lost most of the spark and interest. And so it was really in my senior year of college, I signed up for a course called International Monetary History. And it was co-taught by Neal Ferguson and Charles Mayer. And, both of them are titans in their field. And I think within that day, I just knew that that's what I wanted to do. That was amazing. It.
So you are right at home at Eurodollar University.
I am. So I dropped out of a financial history PhD. My specialty was the history of Chinese central banking.
Oh, wow.
But I actually do work now with Neal Ferguson. We have something called Four Winds Research. Our tagline is actually historical perspectives on the future of digital money. So there you go.
Yeah, I think that's really you do have to understand the past in order to understand where everything's going in the future. So it's great to be grounded in the past and let you know history.
Yeah. So I've been thinking about these questions of money for a while. I mean, I think Bitcoin really came into my consciousness must have been 2013, 2014. And then one of my mentors, she's a constitutional law professor at Harvard Law. She talked me out of buying it, so I regret that, which is why I then had to work for the next 10 years. But had I ignored her, I'd be in a different place. So I really began there thinking about Bitcoin as money. So I really thought about the nature of money. So I think when the bull market came in 2016, 2017, and everyone was asking what is money, I had been thinking about that question now for a long time, which is how I got involved with a number of projects. So I'm an advisor to Block Tower Capital, to Ampleforth, I guess Eco now, Dyad, so a couple other projects. So I've been thinking a lot about the nature of money. And then it was really in 2020, I had a shift because that's when I realized that DeFi worked. So decentralized finance actually worked, and smart contracts do in fact do what they're supposed to do. And I started thinking about crypto as really two things, kind of this Bitcoin store value thing that looks a lot like digital gold, and then all these other technologies that look a lot more like the Web 2 boom of the 1990s. And the outcomes of that, I think, are going to be felt through massive new efficiencies in the financial system. So I'm still trying to grapple with all that and still looking back to history, 500 years. So
Let's unpack a little bit of this.
Yeah,
right?
of course.
For people who aren't familiar with some of the things you just said.
Yeah.
DeFi, smart contracts. Give us a little bit of background in that, just in very simple terms, so we can get a sense of it.
Centralized finance or traditional finance.
TradFi.
TradFi, as we call
TradFi.
it. We're not that cool, though. TradFi has something called an intermediary. So in the United States, financial activity itself is not regulated. You and I can trade whatever we want. It's been an intermediary that's regulated. So, for example, if I wanted to sell some stock, right, I go to a stock exchange, I give it to a broker. He will then find a party to then buy it from me. He's intermediating that transaction. So you have two parties and someone in the middle. Decentralized finance basically says financial activity can be programmed in this computer, this world computer. Let's ignore how it works for now, on that computer as a peer-to-peer activity. So it's a set of rules. They're basically constrained by the mathematics of the code, but it's peer-to-peer in the same way that we can communicate with encrypted messages, right, that nobody else can read. And that's just the outcome of how that code is structured. People had this idea that if you structure the code properly, you can do peer-to-peer financial activity. So it goes from being this kind of trust-based problem, an institutional problem, to an engineering problem, because now we just have to figure out the right sequence of equations.
And that's really what smart contracts are about, are making sure that we have the common language and protocols and terminology and everything else worked out ahead of time.
Exactly. I actually hate the term smart contracts because everyone's like, oh, well, you still need lawyers. I'm like, shut up. That's not what it's about. It's about peer-to-peer financial activity.
And being comfortable with the fact that you can communicate with somebody you don't otherwise know.
Yeah.
Which is always, I mean, that's where intermediation comes. Let's detour a little bit into history.
Yeah.
That was the purpose of the intermediaries, to overcome information asymmetry. I know something about the person on the other side of the trade, so you don't need to know exactly everything about them. I'll stand in the middle.
Yeah.
Which, given the restraints of the time, that made sense.
Mm-hmm.
But if you and I can talk directly and cut that person out, there's a whole bunch of unlocked future there.
Yeah, I think so. I mean, we'll detour later into this question. I am not entirely sure that. So intermediation poses certain types of risks, right? You have to trust the institution that's intermediating. You have to trust that they're not leaking information, that they're not adverse players in the market against you with information that they have about you. This is a problem with the big banks, right? Because they see you trading on one side and then
they know everything.
Their hedge fund is trading against you on the other side. But I think there's some things that are probably irreducible risks for certain types of financial activity, and somebody stands in the middle, not necessarily intermediating, but absorbing the risk for whatever's happening between us. This is kind of one of the things I've been thinking about, the perennial question of payments. So it's like somebody has to absorb that shock in the middle, and if that person goes under, then the transaction doesn't go through. So, but yeah, intermediation. That's trying to get rid of it.
The other side of that, there is value in intermediation, given the circumstances. It's not inherently evil or inherently bad.
Oh yeah.
It has absolutely been abused and then some, but that's true of any kind of human system.
Yeah.
But intermediation as a function, I think, won't you believe that maybe that will survive in some other form, even in a decentralized format?
Yeah, absolutely. I think it survives. I wrote a thing. It might have been 2-3 years now. No, it must. Yeah, early 2022. I think I wrote an essay called "Is Crypto Ready for Its Volcker Shock?" Or "Are you ready for a crypto Volcker shock?" So I was predicting higher rates and they should sell everything. So I did sell everything, I think, in February of 2022.
Did you buy it back though?
No, yes, I'm always slow to go risk on. So I did go a little bit risk on last fall, but then the market caught me sitting 70% in stables this year, so missed on a lot.
Well, let's talk about that too. The stable coins versus, say, Bitcoin. There's a big difference there. They have very different functions. Let's break that down a little bit.
Right. So, well, actually, so maybe this is just to circle back really quickly to this framework. So your stable coins are providing, I think, kind of this payments, digital currency. That is true digital currency, right? It's things that you use to intermediate payments, right, or to settle payments between individuals. I was then looking at gold as gold as an analogy for Bitcoin, right? And so the main critique that people have about Bitcoin is that it's not stable in value, unlike, say, a stablecoin. And they compare, you hear the economists saying, how dare you compare this to gold? So if you look at gold during the 70s and 80s, it looks a lot like Bitcoin. It goes up 400% and then it falls 80%. So it behaves a lot like Bitcoin in terms of its price behavior. And it's basically responding to monetary policy, to monetary and fiscal policy, right? And so the Volcker shock just causes this collapse of like 80%, I think, over 2 years in the price. And so gold behaves like this, Bitcoin behaves like this. So that's one thing that's crypto. So now we have two things that are crypto, right? Stablecoins, Bitcoin. The third thing that is crypto, and it's confusing for everyone because they all are called crypto. The third thing is what I call DeFi. And so the model that I use to think about DeFi is another thing that I've been researching a lot in the past few years, which is the nature of social media. So if you think about a newspaper versus Facebook, right? A newspaper is an intermediary for certain types of information. You have to submit an article. It's curated, it's permissioned, and they take a big cut, right? It's all this advertising revenue used to go through newspapers. Facebook, on the other hand, is permissionless. You upload whatever user content you do. They have a very effective onboarding platform for advertisers. They don't even know what ads they're running on their platform. And so they sucked out all the ad dollars from the traditional ecosystem. And it's far more efficient, right? They're per worker. They make so much more money. I think for advertisers, it's less expensive. Too, right? You're not paying $1,000 for an ad in a local newspaper whom no one might ever see. So that's what happened there. And I was doing a comparison between Uniswap and Coinbase. And at that point, I think Uniswap had 20 employees or something like that. Coinbase had 1,000, 2,000. Coinbase, I think that year had made like 2 billion something in fees. And Uniswap, I think, had made zero in fees, but potentially could have made maybe like 50 million or something. But they were doing about, on Ethereum itself, they were doing about the same amount of volume. And so I thought to myself, well, isn't this funny? It's such a apt parallel, right? Uniswap is permissionless. It's an online kind of DeFi exchange. Anyone can list any pair of assets on there to trade. You can trade without having to register or anything. So it looks a lot more like Facebook. And I think at that point in time, they had 3,400 pairs of assets. Coinbase had 84 or something like that. I don't remember my own essays. But, they're different by two orders of magnitude, both in terms of the cost and in terms of their reach. And so to me, it was like, I was thinking, this is
sort of an aha moment.
Yeah, I was like, these are basically like .com stocks. And they also, of course, go down when the interest rates go up. But the winning move was to buy a bunch of stuff in 2001, 2002, 2003 before the market turned around.
After all the shakeout was done, right?
Exactly. So there was a lot. There was a lot of nonsense in the 90s. I remember this because that's when I moved to the U.S. and my dad worked in tech, pets.com, all this other stuff.
Hey, I was right there. I was in financial services.
Yeah, and then, there's a blow off top, and then it just all goes down. But yeah, so there's three things called crypto. You have your stable coins for settling payments. You have Bitcoin, which is digital gold, and you have these very efficiency generating technologies called DeFi. But it's confusing because they're all the same thing.
Yeah, they're called the same thing, but they have very different functions. But
exactly.
You just made a point here, I think, that we really want to emphasize is that we've been through this before.
Oh, yeah.
This is nothing new. Disruptive technology follows a pretty deterministic pattern, right? And we just hit on the big part of it, right? You have this initial phase, a new technology comes out, and everybody's like, wow, I can see this is going to work. Yeah. And then everybody rushes in, a whole bunch of capital gets deployed, and it attracts a whole ton of stupid ideas.
Yes.
And it takes a big process to work through that, clean out the losers. But then the survivors, those are the ones, as you were just saying, those are the ones you want to look to. And aren't we seeing something similar to that happening in, crypto?
It's so hard to escape the cage of our own language. I try, but it's impossible.
Let me lead you into the second question. Are we seeing this disruptive technology cycle in crypto, or is there three different cycles? Are there three cycles, one for the Bitcoin types, one for stable coins, and one for DeFi? And are they synchronized?
I think they're somewhat synchronized, which is strange. So I was thinking about this question because I was trying to decide my own portfolio allocation. I think I'm going to go 30% Bitcoin.
Oh, really?
30%, yeah. I think Bitcoin, as I mentioned before, it just captures the macro impulse. It captures macro signals about the fact that the Biden government is spending so much money through its Inflation Reduction Act. We're probably going to juice the numbers before the election. There's all this stuff in the water that is coming. We're not getting spending under control, and we're monetizing the debt. So I think Bitcoin's a perfect asset to capture that. As I said before, with my financial history background, I kind of started writing and designing stablecoins in 2020. So I am bullish on that as a builder, right? So that's what I'm working on.
Yeah, that's not a price thing. That's about a functionality.
Exactly. And so it links to the price in the sense that the DeFi functionality, let me think about it this way. You can think of DeFi chains, right? So the blockchains on which all these contracts run as their own little economies, their own little countries. And so the economic activity there requires natively generated liquidity to really ramp up. And so this is kind of that central problem of history, is how do you generate liquidity for financial activity, for financial and economic activity, really. And so they're linked in this way because the people that are most likely to put money into DeFi are also, like me, most likely to have money in Bitcoin. So the cycles get synchronized in this way. And I think the stablecoin piece is really the bit that allows the DeFi cycle to run really well. I don't think it's as important for Bitcoin.
It almost sounds like there's the equity for DeFi comes from Bitcoin. That might be a little bit too stretching the analogy a little bit too much, but I mean, that's kind of the idea.
Yeah.
So if the crypto cycle is generated by Bitcoin, then it has all of these spin-off benefits, and they really are benefits that could synchronize the cycle, but also create all of these additional opportunities.
Yeah. I mean, that's one way to think about it, as the equity of DeFi. There's another analogy. It's not mine. It's actually Neal's, where, by the way, he hadn't seen the Citadel memes yet. And yet what he told me, I think, aligned with it perfectly. So he thinks of major Bitcoin holders as kind of your aristocratic medieval families that are landowners. And so they end up with all this wealth, but it's locked in the land. And so when the financial and commercial revolutions happen after the Renaissance and early modern era, how do you mobilize that, right? You have to financialize it. Otherwise, you can't do anything with it. And so, it's the Citadel meme, right? So people that bought earlier at the top, and the rest of us are the peasants at the bottom. But we have a chance in this cycle.
Yeah, exactly.
Yeah, where we say, hey, look, you don't know what to do with all your wealth that's locked in Bitcoin. Why don't you let me borrow some of that? So I think that's what's happening.
So let's circle back to stablecoins. Okay, stablecoins have a specific purpose. They have a role in this crypto space, or this crypto, what would you call it? Ecosystem. Really, that's what it is. Let's talk about stablecoins, because I think most people may not understand their purpose or how they actually work. And we don't need to get into the details of how they work, but it is, I think, really important to understand what their purpose is. In one respect, they came out of that volatility from Bitcoin to fill a role that Bitcoin really wasn't.
Yeah. It's funny you asked this. I've been trying to explain stablecoins, I think, for the past 2 days to people. So I have a following framework. I'm going to test it on your viewers.
This will be awesome.
So if you look throughout history, there's three ways, really, I think, of creating liquidity. And liquidity is just a medium for settling payments, right?
Right. It's doing so fluidly and efficiently.
Exactly. And so sometimes it's invisible. Sometimes it's just, me debiting your deposit account, or, something equally immaterial as that. But the first way is, I would call it minting. So it's the creation of what we call outside money, I think, in certain terms, which is money that is not redeemable in anything else. It's not a claim against anything. It's that gold coin. What is a gold coin? It's a gold coin.
It's zero liability.
Exactly. Yeah. So what is a Bitcoin? It's just a Bitcoin, right? And so that kind of money is volatile in its own ways, but that's one way of making money. There's two other ways of making money, and they require making inside money. So inside money is your classic kind of bank ledger kind of approach. I'm sure your viewers are familiar with.
Oh yeah, ledger. We know about ledgers.
Yeah, you know about ledgers. You know about inside and outside money. So inside money really is it's created in a pair. So you have an asset and you have a liability, and in the end, it all nets out to zero. So if the Bank of we bank with eco and we're sending transactions, you and me and other people. At the end of a cycle, people, the bank will net out the transactions, right? And they mostly all net out to zero, right? So is it real money? I mean, it is true liquidity. It did facilitate exchange, but it's not outside money because it settles out to zero. So there's two ways of making money in that way. One is what I call variable funding. Your viewers might notice margin leverage through like brokerages. Historically was known as like merchant credit, intrafirm lending, where you're basically watching, I look at your assets, you show me your books, and you say, man, I need $500 million. I look at your books and I say, okay, he has $1 billion in securities. And I say, I'll lend you $500 million for 2 days. Okay, fine. At whatever, 5%. That's kind of variable funding. And then fixed rate funding, which we now know primarily as bonds, but also includes mortgages and things of that sort. So stable coins are actually in the last two categories. Most of your big stable coins like Maker, Liquidity, and whatever are basically margin lending collateral stable coins. So, I deposit some crypto asset and then I borrow against it and I call it a stable coin. But it all settles out to zero. If you see what I mean, it's not real money,
right?
It's not outside money. It's not outside money.
It's definitely real money, though.
Yeah, it's inside money, but it's not outside money. And then what I'm working on is designing, obviously, a stable coin that uses fixed funding, kind of a fixed funding model, to create a much more stable kind of stable coin that can then circulate more broadly and scale up further. So that's how I would think about stable coins. Tether and USDC are definitely in the first category. Why? Because they're just wrapping true outside money. They're just wrapping dollars in a bank account,
right?
Which are backed by the full faith of the United States federal government.
Whatever
as we found out, I mean, someone was saying, like, who was it? I think it was Athena, was claiming that you don't want a stable coin collateralized by dollars in a bank account. And I said, are you crazy? The U.S. will bail out all its banks. It's like it's backed by the most powerful empire in the history of the world. Of course, I'm going to pick that coin, over the others. So
yeah, I mean, there's a history behind that too. Because, a lot of this comes down to, and every monetary topic comes down to, trust and faith.
Yeah,
and that's really kind of the situation we find ourselves. And why I started out with the analogy I did, because for most people who are not inside this business as you are, a lot of this looks scary. Looks hella scary. I mean, it's like you hear scams, you hear people losing money, these volatile cycles. Oh my God, the volatility in price. For most people who are not really close to the what's actually happening, the lack of information is prohibitive.
Yeah,
it makes it very difficult to make informed decisions about this.
Yeah,
and I think that's one of the reasons why we want to get into these details and really understand the history and understand that this is just natural behavior.
Yeah.
And there's a purpose behind both the reason we got here and where we're actually going.
Right.
So are there any other historical analogies that you could think of that would be useful in understanding the transition?
So many. This is
sort of a loaded softball question here.
Well, before I answer that question, I was going to say the confusion and, I guess, fear around participating in this ecosystem is one of the reasons that I appreciate kind of what you do. The United States, I guess, modern Western society has such a low level of financial literacy.
Oh yeah, unbelievable.
The things that are happening in DeFi should not be that difficult to understand. But even the people building in the space coming with such low levels of financial literacy that they build really dumb things. Like Basis Cash was built by someone who just took economics 101 at Princeton and now thought that they knew how to solve all the world's monetary problems. They don't even understand how the banking system works, how money works. I think your average person knows a little bit less. The people that are found to be quite savvy about this, funny enough, are people of my background that come from like third world countries, because we have to deal with unstable financial institutions all the time.
It's an actual fact of your life.
Yeah. So we know what we're doing. Right. We're like, okay, the money's not going to be 100%.
You know what doesn't work.
Yeah. It's like, you're promising me a return. So what's the catch? Where's the risk? There's no reward without risk. So right. I see this as well as in Asia, the way people think about preserving wealth and all these other things throughout families.
That's where you see a lot of this digital currency, crypto stuff. Asia, emerging market focus, because they have the immediate problem.
Yeah.
And you're right, most Americans, Western people, they don't really think about those
What's
things.
really funny is it's that you need the Western ethos. It's really the American ethos of open source software to drive this, where we're saying we'll build this stuff and we won't intermediate, we won't collect the rents in the middle.
Right.
That's insane to a European or an Asian kind of innovator. But you need their sensibilities to really prune out all the bad ideas, I think, that accumulate from the American kind of naivete.
There's also another part of that too. Is we've been talking about this during the conference. Yeah. By the way, I didn't say so, but we're actually in Denver at the ETH Denver conference. Was one reason I want to come here to talk with people like yourself.
Yeah.
And get a real good sense about what's actually happening here. And one of the things that we've been talking about is underappreciated aspect of the internationalization of the dollar is the respect for privacy and contracts, which is something you can't really overstate, especially given the alternatives where some of that stuff is less certain and less ideal.
Yeah,
where you enter into a business arrangement with a counterparty, you're not actually sure if they're going to live up to the terms, and there's no means to intermediate and settle it. And so one of the things that I've noticed is that you're right. There's the interest in cryptocurrency and using it comes from places where it needs to be used, but the people who are building it tend to be here in America.
At ETH Denver,
and I think that's a good
and
thing.
We're dressed up in unicorn onesies, and dancing around.
That's part of it
with pink bonbons. Yeah, so I think it's a very potent mix when you have kind of the idealists and the realists, I think, working on the same stuff.
Isn't that the best?
Yeah.
Because then you're drawing from the best of both pools, and you do need both. You need both sides of it.
Yeah. Well, I would argue if you just studied history, you would know what to do.
A true historian.
Because you just look at, like, it's a cheat code.
Another thing, man, that's another thing I've noticed too, is that it's historians, philosophers, and it's engineers.
Yeah.
That is an awesome mix. Because you need the engineers because they know how to build things.
Yeah.
But you also need the philosophers and the historians because they can look back and say, okay, we understand what it is we need to build.
Yeah.
And you need both of those put together. So I think one of the most positive aspects that I've seen just coming here, as well as just, investigating the space, is how much interest there is among these various groups of people, which means once you get a critical mass and you have a large enough pool of people to draw from, inevitably the magic happens.
Yeah. I mean, I'll be, not to shill my own book, but for me, I eventually did leave academia, but a lot of it was I struggled within academic history, which has turned into kind of, it's basically, I would call it glorified journalism through the identity lens. I think that's kind of what they focus on. And, I'm trying to understand the nature of money and finance and so on. So I was struggling to get traction because those are just not fashionable things. And yet, anytime I talk to crypto builders, it's like things that are obvious to me, to them are like such valuable pieces of knowledge. And I thought to myself, you know what? Here are people that appreciate kind of the work that I do and the insights that they might derive from it. I can't possibly build all the ideas that I have. So I'm more than happy to share them. And, hopefully people take my angel checks to then build it. But, it's a fantastic mix. I think there's a lack of historical awareness and knowledge, I think, within our field. And that's not anyone's fault. I think that's a failure of our education system, broadly speaking. Failure of academia and kind of its publishing kind of biases, I think, both in books, which publish very boring books, and then articles, which are unintelligible jargon. So, it's one of the things that I'm trying to rectify. It's obviously one of the things that Neal tries to rectify all the time as well.
Yeah, we need a historical update. Literacy, not just about financial literacy, but also historical literacy, because a lot of the stuff, and you see this all the time. The problems that the crypto space is working through, people have worked through already.
Yeah,
it's not exactly a roadmap. There's a lot of hard lessons that have already been learned that could be useful and helpful in a lot of different ways.
Yeah, I think that's right. I can tell you about what I talked about yesterday, which basically
we need to get into that.
So, I think it was positioned as the counterweight for all the people that were for all the people that were advocating
selling and
advertising real world assets on chain, right? Especially treasuries, which I know you've probably talked about a lot. And so I went up there, and what was the title of my talk? I think I changed it last minute. It was The Future of Crypto is Yield, A History of Government Debt and Liquid Staking. And so what I tried to do in that presentation was do a brief comparison between two things. So, what are going to be crypto treasuries? So what are treasuries really? And I mean here treasuries not as the actual instrument today, but really as government debt as this foundational piece of all systemically important financial institutions. So that was the history of 400 years that was compressing into this presentation. And then I was trying to figure out which asset in crypto actually fits that pattern the most. And so the history of government debt, right? So it used to be that government debt was not your risk-free asset. It did not give you a risk-free rate. It was the riskiest thing you could do.
Worst.
Because in fact, the king was never going to pay you back. And if you protested, you were going to die.
You had no means of arbitration. Exactly.
So if you look at, rates over time, they declined precipitously after the 1600s as people realized how to issue credible debt. So the first step of kind of this evolution of government debt as the central asset of the financial system is credible commitments. Begins in 1688 with the Glorious Revolution in England and the kind of the constitutional innovation there of separating kind of the powers into legislative, judicial, and executive. I promise this is not a Putin-like interview where I go on for 40 minutes about history since medieval England.
Actually, I think our people would like that. Yeah.
So I have a meme about that. I actually did put text of my talk in that meme. But so you begin in 1688, the king gets overthrown, and then monarchy gets reinstated, and you now have Parliament with the taxation power, right? Basically controlling the issuance of debt to fund the expenses of the king's household and the king's government. And that's when the Bank of England gets created to basically, sell and the government debt,
price,
and then repay it. So that's innovation number one. The second step in this is in the 1720s, which is with the boom in exchanges, securities exchanges. And that's because you have the South Sea bubble and the Mississippi bubble. Equities get invented. There's a massive bubble. Newton loses a third of his wealth because, the smartest man alive on the planet cannot resist aping in at the top with his friends. So,
that's human nature.
I know.
So much this is human nature.
You can be as smart as you are and you will still lose money in the market. Everyone that's lost money, you should feel a little bit better. But what's interesting is, so the French shut down their financial markets because too many aristocrats were involved, too many people were pissed off, so everything gets shut down. You can't even really do credit intermediation anymore in the, through kind of local small entities. The Brits passed something called the Bubble Act, and so you're not supposed to issue stock anymore. And this is in place for 100 years, so only 2 companies get a royal charter to this. But that's not what actually happens. So there's like hundreds of companies that issue stock, and they continue trading on this exchange. So if this sounds a little bit familiar, like unregistered securities, tokens
outside the official
trading on Uniswap.
Mm-hmm. Trading Uniswap.
I mean, this is literally what I'm thinking. You're not supposed to do it, but no one's really going to shut it down because there's kind of a legal gray area,
but also because there is a use. It's not just happening in a vacuum.
So. Yes and no. So the first use case was in fact speculation, but that only lasts for a few years, right? And then you have kind of this slow period that in this case lasts 100 years. And what's really great about it is you have all these merchant families and traders like building up expertise on like, how do I make a market? How should I manage risk, right? This is like vital human knowledge that needs to be built up over 100 years. The third innovation is actually what I call kind of steady yield. So you're a little bit right that it starts to serve a purpose. So you're trading all these stocks, whatever they're speculative, they're based on these risky ventures. The government starts trying to sell bonds on the exchanges. So they experiment with a variety of different bond types. They have like lottery bonds, your traditional fixed rate bonds, a bunch of other strange things that don't exist anymore. And then they chance upon something called the consolidated annuity in 1751. And it's a piece of paper. They're all fungible. So even if you issue them years later, they're all basically the same because they all yield 3% per year. That's it. So you buy this thing.
That was the magic number?
So you buy this thing, you pay your 10 pounds sterling, and every year you go collect your 3% yield. this turns out to be an incredibly powerful instrument, right? One, because unlike modern bonds today, your liquidity can actually exist on a two-sided exchange, right? That's live. Your liquidity is all concentrated in a single market. And two, because of the credible commitment that I just discussed earlier, you actually know that you'll get paid your 3%. And so it's such a smooth, wonderful thing that gets invented there. And this plays a big role during the wars against Napoleon, because as I just said, the French shut down all their financial markets. So Napoleon finances his wars through things that some people might find admirable: taxation, direct taxation, and pillaging and looting your neighbors. Yeah. So he does run a balanced budget, but it's not out of choice. It's because nobody wants to buy French debt because you'll get paid back in worthless stuff.
Or a gun shoved in your face.
Yeah. So the British, on the other hand, and I shared a graph yesterday, are able to run these massive budget deficits because, one, all the displaced princes, bishops, merchants from continental Europe send all their money and capital to London, and they're investing in what? They're investing in consoles yielding 3% a year. So this really cool new asset, financial instrument, just balloons in size. It becomes massive because it just absorbs all these inflows, and the government needs to do all these expenditures. They're funding not only their own navy and their own army, they're using their bond sales to then get gold that then gets distributed out to their allies on the continent, because these are the people actually fighting and dying against Napoleon. By the way, this is how the Rothschilds make all their money. So it's not through the speculation in the bond market. It's actually the mirror side of government debt issuance is the actual distribution of hard currency in the battle zone. And that's what they manage. They manage the remittance networks, and they charge the fees on that. And that's how they get rich.
And those are the intermediaries.
Exactly.
We always need intermediaries.
Because at the end of it, you do need someone to physically carry the gold back out. You need to find
literal intermediation.
Literally, you need to go through enemy lines. Yeah. So, people complain about them having made all that money, but nobody else was stepping up to do this because you would, in fact, get killed. Right. It was actually not risk-free. So you see this happening, and at the end of the war, you could say 1815, but really it happens like in the mid 1844, I guess, when the Bank of England gets its kind of new issuance rights and all that stuff. That's when government debt really becomes a really important collateral for a new class of things like banks, right? Because now they have all these assets, insurance companies, all these other things. And that's really the beginning of it all. I think that's actually the original sin when people say that the central bank should be the lender of last resort. I think that's a massive mistake. When I was younger, I used to believe that. Now I've realized that has led it to the inexorable rise of government intervention. But that's really the innovation. That's the history of government debt. I was thinking about what instrument kind of mimics this or parallels this history of the evolution of government debt as a foundational financial asset. And it wasn't tokenized treasuries, it was liquid staking tokens. So,
okay. You got to explain that a little bit better.
Oh, dang it.
Yeah.
So liquid staking is, I would see it as participating in securing the blockchain. Right. So if you have some ETH, you lock it up in a particular way, and you use that ETH to then secure all the transactions that go through the network. And in return, the ETH network will give you 3% back ETH over a year. So again, I thought it
kind of sounds familiar.
I know. When I thought about it, I was like, is it really 3%? Because that's oddly familiar. That seems to be the rate. It's not 2, it's not 1, it's not 5. I don't know what
just
it is.
Right, because it's not too high because then it becomes prohibitive. And it's not too low, or because it's not enough of a return to engage in it. So maybe there's some underlying humanity there. That 3% is the right return.
I think it might be a human psychology kind of universal.
So do you see the same type of development pathway? I mean, that was an extended, long period of time because that's
100
human history
years.
Pretty slow at that particular time. And progress was.
Yeah.
Is there a similar pathway in cryptocurrency, and are you seeing that actually happen?
So,
because that's the real question.
I did. So for example, Poolside is, as I mentioned, this specialized liquidity pool for yield-bearing assets. When I came up with this idea in 2020, early 2021, there were no yield-bearing assets on chain, right? Everything was just a fixed token. There were no rebasing assets that represent the yield either. So I added up kind of all the categories of yield-bearing assets. So liquid staking tokens that we just described, your lending positions on lending markets, because you're lending out dollars and you're getting paid back in dollars, a certain interest rate. That's really a yield-bearing position. You're rebasing currencies and flat coins that adjust with inflation. And then the last one was tokenized real-world assets. So I added up all the value locked in these protocols since 2021. And what I saw was that yield-bearing assets are now like 70 or 80% of all decentralized finance value locked in any type of protocol. So it's now the dominant asset class. So the future...
Wow, that's a pretty quick evolution transition.
It is. And this is why I was saying, the future of DeFi is in fact yield. It's yield-based. And so, but when you break it down, rebasing currencies are basically invisible in this graph. I was surprised to discover that real world assets, for all the hype that they get and all the institutional attention that they get, were also basically insignificant. I think I haven't updated the numbers since the end of last year, but back then it was maybe between half to $1 billion out of a total TVL in DeFi of 50 something. So it's like very, very small.
Wow.
The lending positions, kind of the lending market assets, had shrunk down considerably. They used to be the bulk of kind of DeFi activity. Now they're relatively small. But liquid staking on its own is over 60% of DeFi TVL right now. So it is already the largest. It's the largest
emerging class as the big base.
Yeah. And so they basically start at 0.1% in 2021 and now are at 60 something, probably higher now with liquid restaking, which is a rehypothecation means of doing that, which it's kind of novel. And
this is where all seriousness, this is where people they're like, okay, I get kind of the baseline, or I get the idea, I get the pathway here, but how some of that stuff works and how it actually gets put together. Yeah. Even the terminology and jargon are somewhat difficult to overcome. Which is why I think it's helpful to go back through the historical example and say, people struggled with the same things every time this happened. A console? What's that? Yeah. There was a time when nobody knew what that actually was, except for those people who actually were involved in it.
Exactly. And nobody really knew where things were going. I think in this case, you can cheat a little bit, like I said. But even this caught me by surprise because the transition was so quick. Right. 2 years. Not 150, 2 years.
2 years is nothing on a time scale of the evolutions and the radical changes we're talking about. That's nothing.
And so there's a moment in time between when this asset emerges as with its steady yield. I think of it as the base of the food chain, right? So it's just kind of like the plankton at the bottom. That 3% will feed all the more complicated organisms that are built on top. Once that is invented, and then from when that food chain actually gets built, that's when you see massive inflows, right? In the British case, it was during the massive world war against Napoleonic France. I was not entirely sure what was going to drive all the big inflows this cycle. I mean, we'll see. But I think probably liquid staking gets much larger, and then building protocols that are natively compatible with yield and the way that yield gets generated on chain are going to be huge. And I think that there's one of the things that I love this conference. I love ETH Denver, but ETH people tend to be pretty dogmatic sometimes. So they're anti-rebasing and they were anti-yield, really. So most of the original protocols are not compatible with yield-bearing assets. So people just lose money. They lose their yield. I think you're going to see a new generation of protocols built around the yield itself. So,
okay, that's interesting too. That there are pockets of people who have their own personal dogma, their own personal views, and it's tough to get them to. But then again, I mean, that's again human nature. But what I really wanted to ask you, what I really want to talk about was, I think what's positive about all that is that what you're describing is the processes that lead to sustainability. The pathway forward is that there is a sustainable capability that's going on right now as we're talking that makes this more than just a flash in the pan. Exactly. Yes, we have the disruptive technology, you have all the flashes and bells and whistles and all that stuff. But at the end of the day, this is the stuff that needs to happen.
Exactly. We can't live in the Mississippi and South Sea bubble era forever,
No.
issuing pointless stocks and then hoping that somebody
Right.
buys
Just
them at a higher price.
What's the next Dogecoin, right?
Exactly. So I think the invention of on-chain yield, by the way, Neal and I got a lot of flack from Brad DeLong for making this analogy, because he's like, well, the yield is, in dollar terms, it fluctuates. I'm like, well, yeah, of course. But if you bought, Japanese bonds yielding yen, then the yield is also volatile in dollar terms, right? So in its own native terms, it is in fact a fixed 3% yield. I think that allows you to then build sustainable structures on top, right? Because it's no longer just trying to issue a token and cycle it back out,
which is always inherently unstable, and that's the foundation of sand. And I think there is a perception that's all that there is here.
Yeah,
and I think that's one of the things I want to correct in talking to people like yourself. Because you're actually doing that thing, which is the thing that needs to happen that leads to the next stage.
Yeah.
So can we talk a little bit about what do you see as the next stage here? So if we're getting the yield-based securities that's coming in, that's becoming more and more of a stable proposition.
Yeah.
In your analogy, now we're taking things seriously. We're creating credible underlying assets and way to do things. So what's the next step?
Ooh, that's a hard one.
It is, and I did that. It's intentional. I figured if I'm going to ask that of somebody, I'm going to ask it from you.
So there's a couple things that I'm thinking about. So I think there's this question of hedging risk, and hedging doesn't actually mean canceling it out. It actually means defining it with hedges like you do with land, and then selling it and transfer. So risk transfer on chain, I think, is still in its infancy. I think the only thing people know how to do now is split the yield from its base token.
Oh,
but okay. We need to learn other ways of doing risk transfers on chain. I think that's one. I don't want to call it insurance, because that's not what this is. It's something slightly different. Insurance is kind of a narrow piece of that. So that's, I think, what comes next. I think a lot of the existing DeFi infrastructure needs to get revamped to be yield compatible. So I've been pushing rebasing for a long time as a way of better representing the yield information for a token rather than having to ping an oracle. It's in the token itself. So I think a lot of infrastructure gets revamped. I think your AMMs, your automated market makers, your lending platforms, all of them have to get revamped to accommodate yield. That's probably the second big thing. And then the third big thing is really this liquidity question that we started with. So how do you create on-chain liquidity in a sustainable way? And I think the big unlock there will be, in fact, kind of these fixed funding designs for stablecoins, right? Which will be probably collateralized now with these yield-bearing assets. Before, it was a little wishy-washy. It was like, put in some ETH, you borrow against it. It's clearly speculative. Here, you could say, well, the protocol is collecting the yield that accumulates. So the buffer there to protect the inside money against, well, I don't believe in on-demand redemptions. This is a topic for another day. But, the buffer there for volatility will grow over time. This looks a little bit like a bank.
It does.
But it shouldn't be, because it's going to be peer-to-peer. So who are the bankers, right? So I think you're basically end up building these banks. You build up kind of a...
But these are not banks as they're described traditionally. They have a specific function that is, it's almost necessary function, but it's not like we're going in.
Well, so there's a myth about banks, if I can do a 30-second detour. So
absolutely.
Economists will tell you that banks do maturity transformation, right?
Yeah.
Hey, I get your short-term deposits, and then I do the long-term investment, and I take the risk in the middle. That's bullshit, frankly. So I was compiling all the information on bank failures and bank runs in the US since 1920. I'll send you some very cool graphs. But anyways, the cost of backstopping the financial system has grown exponentially over time in inflation-adjusted terms, which is insane, right? If regulations worked, it would be the opposite. So clearly what we're doing doesn't work. But I was looking at the composition of bank assets because now I can look at it. It's like 55 or 60% of it is just hyper liquid securities like treasuries. Mm-hmm. And then 20% is commercial real estate lending and 20% is something else. But what banks really are, they're baskets, they're balloons of liquid government debt, and then you just run payments through it, and that justifies their existence.
Yeah.
But you can
they've turned that into a special privilege and a pedestal.
Exactly. But I think crypto is going to, or sorry, DeFi is going to unbundle.
So you do it too.
I do it all the time. I mean, you know, this is why we say historical perspectives on the future of digital money. It's like, it's not crypto. I don't know what NFTs are. Don't talk to me about that. I don't own an ape. But banks today will be unbundled, I think, by this new technology, right? Because you have the lending, the true intermediation piece. That needs to be carved out in its own thing. It does. Why are we running payments through this mixed thing, right? We really just need to be running payments through the yield-bearing, basket of securities here, because it serves a purpose. I have come to accept. You kind of do need kind of this.
Well, it's kind of elegant. It is. There is it's not perfect, but it works.
Yeah. So I think stablecoin protocols in the future will be one half of the bank. They'll be the part that handles the payments and settles it through this stable basket of assets. The other half of the bank that does the true lending and has to do
the risk taking,
actually has to think about risk.
Yeah.
I have no idea how that will be done on chain. That seems really hard. People have been trying through under collateralized lending. It's not under collateralized.
It's just normal lending.
It's always collateralized by future cash flows.
Right.
But you need to think about that. And I think the mistake that we've done here is, because of the way that the government backstop with industry works, is you have forced these two things that really should be separate. And I think they will be unbundled. So that's kind of what I see in the future.
Yeah, I don't think some of that isn't. I don't think is necessarily government. I think it was necessity of the limitations of technology and everything else. It sort of just grew organically, and I think the regulations kind of came in afterwards and said, "How do we try to make this less prone to flights of risk at these particular points in time?" And that's I think one of the promises for crypto space is to be able to find a more elegant solution to do the same function without all of the baggage that comes with it. And there's more efficiency potential there, as well as just maybe hopefully less prone to volatility and super bubble type of behavior. I'm a little bit worried about that, but that's the opportunity though. It's because you're basically, it's not necessarily a blank canvas, but there's, as you're saying, there's definitely different ways to do this.
Yeah. Yeah. I still think it's primarily legislation. I'll recommend a book to you by a friend of mine who is now the chief economist at ExxonMobil. It's called Legislating Instability. It's Tyler Goodspeed. And so it's a look at the Bank of Ireland's failure, I think, in the Scottish pre-banking era. But, Adam Smith was writing at that point saying, all these small banks they should be regulated out or whatever. These laws had already passed. He had been advocating it because all his friends were running banks too, the large banks. So we've definitely made banks more fragile over time through legislation. And then their own fragility then demands that we intervene to save them, which it sets off this very vicious cycle. And so then they get very big and very important, and now we can't let them go under.
Right. And because I think it's because we have the payment system running through, as you were pointing out. That's the piece where you say, oh, okay, now we really have to protect them.
And that was
separate that out, and suddenly they're not so special.
Right. Well, we did bail broker dealers during 2008.
But those are the real secrets of intermediation
for the U.S. government. They're the payment rails for the U.S. government.
Yeah, the payment rails.
So, yeah.
Yeah. So, okay, let's wrap this up because we could be here forever talking about some of this stuff. But I think from my own perspective, coming here as sort of an outsider, an interested observer, or what do they call it? Crypto adjacent. Crypto adjacent is that there is a lot of good stuff here.
Yeah.
There is a lot of smart people, yourself included, a lot of people who are doing lots of different things and have made substantial and tangible progress already. Which means that this is not something that it's not a flash in the pan. It's not maybe what most people have in their minds. It's FTX. It's all the crap that goes on. It is in many ways the same disruptive technological cycle, but it in a monetary setting, which makes it maybe a little bit more scary, a little bit more dangerous.
Yeah.
But when you have this, I think, critical mass coming together, it actually makes it more of a optimistic future than it is something to be afraid of.
Right. I think that's true. I'll close with this. Neal and I hosted a conference at Stanford's Hoover Institution last year on the history of financial and monetary innovation. You should have been there. You would have loved
I would
that.
have loved that.
I'm
yeah.
sorry I didn't invite you.
It got lost in the mail. That happened.
Nick Carter told me the same thing. He's like, why didn't you send me an invite? I was like, I didn't think you would want to come. Turns out everybody wanted to come.
That's international money is the new sexy.
Exactly. And so it was a great conference because I got to invite people whose work had impacted me since I was a graduate student. And so we looked at things from Asia, Europe, the Americas, the Whistle Bank, cryptocurrency, the history of the corporation. And so there were two insights here. I'll leave you with one that I think is the big one. Evolution really is the right model to think about what's happening here. So all these papers were on such different topics, and yet the theme that came up was that I saw was that almost everything gets independently reinvented over and over again, but in different forms.
Right.
The corporation gets invented at least 20 different times throughout Europe in very different forms. We only remember one because we think that's the ancestor of our current form of limited liability. But it turns out there were other ways of organizing kind of property that had permanent capital that lasted through time. The big perennial question, as I said earlier, was payments. And so you see all these different institutional constellations around this problem of payments across space and time. And so you have kind of diversion and then conversion evolution. So if you think of it in that way, it's not so scary. It's like we do this all the time.
All the time.
It's just that the last few hundred years since the post-war era, or less than 100 years since since World War II, innovation has really slowed down. I think governments have become so interventionist afterwards. We've really interfered with this beautiful machine that generates diversity and then selection and then reproduction of the successful things. And I think in some ways, crypto in its three forms, all its forms, I think has restarted that cycle of history. It's gotten time moving again, I think, in terms of finance.
Yeah, and I think that's incredibly beautiful and hopeful, really.
Yeah.
Given where we are. Manny, I cannot thank you enough for coming in and taking the time. I really appreciate all your insights and everything. So thank you very much
Jeff,
for joining me.
It's been a pleasure. Thank you so much.